Welcome everyone to today's Preparing Your Heirs to Receive an Inheritance webinar. My name is Ed McCahill and I'm a private wealth advisor on the Ronald Blue Trust Seattle team. Our guest speaker today is Russ Crossan, Executive Vice President and Chief Mission Officer of Ronald Blue Trust and Executive Vice Chairman of the Board of our parent company, Thrive and Trust Company. Among Russ's leadership responsibilities as Chief Mission Officer is making sure the mission, which is to help Christians become financially free to assist in fulfilling the Great Commission, is passed down and inculcated into future generations. Prior to his current position, Russ served as President and CEO of Ronald Blue & Company from 2002 to 2017. He was hired by Ron Blue in 1980 as the second employee of Ronald Blue & Company. Russ has worked extensively in all areas of financial planning, specializing in comprehensive financial, estate, and philanthropic planning, as well as generational family wealth management and transfer. From 1999 to 2002, Russ also served as Executive Director of the National Christian Foundation. Russ is the author of several books and has also been a featured speaker in many venues, including Promise Keepers, Issachar Summit, and America's Best Hope. Please join me in welcoming Russ to the webinar.
Hey, thanks, Ed. Thanks for having me today. Looking forward to it.
Yeah, we are as well, Russ. Thank you. So Russ and I will be following an interview format today. I will ask Russ some questions and Russ will reply. If you have brief questions, and I want to specify brief, please enter them into the Zoom chat window accessed at the bottom of your screen. Hover down by the bottom and it'll pop up chat. So enter your questions there. If you have them, we can't promise we'll get to all of them, but we'll do the best we can during the time that we have together. If your question goes unanswered today, please contact your local Ronald Blue Trust advisor, and they will be happy to give you some help. So now let's get started. Russ, can you kick things off with an overview of the risks and rewards of generational wealth transfer?
Yeah, Ed, thank you for asking that, and thanks everybody for joining on this afternoon on this very important topic, preparing heirs for inheritance. So yeah, one of the risks is that we inadvertently undermine our children learning a work ethic and developing some of the characteristics that we developed in our life. And so as you see that diagram there up on the screen, we inadvertently build financial capital without building spiritual and social capital into those who would receive it. So that's a risk. So if you have wealth, how do you manage that wealth in such a way to make sure your children aren't handicapped and learn some of the things that you learned on developing social and spiritual capital? So that's one of the risks. When you leave it, how much you leave, we'll talk about that in a minute, are really critical. One of the rewards is that if you do build spiritual and social capital and you do happen to have some financial capital, the joy of seeing your children carry on the work of the Lord into the next generation by being generous, by building their own businesses, things like that. So Ed, there's both a risk and reward, but you need to be intentional and diligent about how you do it, because you could have some unintended consequences if you're not thinking through it.
Right. So, Russ, just for our guests who don't know, can you explain financial capital, social capital, and spiritual capital?
Well, financial capital is stocks, bonds, real estate, business interests, things like that. It's all the financial instruments, CDs, so forth and so on. Social capital are the characteristics we want to build into our heirs to help them be effective and productive in society. Things like integrity, responsibility, all these types of things. And those usually come from a work ethic. That's why if we leave them too much, we can inadvertently undermine a work ethic, which helps them build a lot of great social capital characteristics. Spiritual capital is understanding God's word and being able to apply it. So we hope that we're passing those on to our children, so that's why that's a little house. They're the foundation. You want to build a foundation before you leave the financial capital.
Great. Thank you, Russ. Yeah, so important to get that right when you're laying on your deathbed with $1 billion, but your kids aren't capable of standing on their own and aren't walking with the Lord. Boy, that sure doesn't make it feel like you're a very rich person, is it? So, well, Russ, three key interrelated questions we often hear are: how much to give to each heir? In what form should the bequest be to each heir? And what is the ideal timing for giving gifts to our heirs? So would you talk us through those questions, please?
Yeah, thanks, Ed. Okay, so let's talk about how much to your kids. Let me give you a principle if you're listening to this webinar. Usually, if your kids are 0 to 20, you err on leaving them less rather than more. And the reason for that is what I just said. What's the worst thing that happens to your kids if you don't give them a lot of money? They have to learn to work and build character. And so enough to get an education, maybe start a business, get a house. But the principle there is less rather than more if your children are young, because the risk of leaving them too much too soon and undermining those things you really want, I think, is too great. As your children mature and their ages 20 to 40 or thereabouts, and they get established in their careers or following after what God's called them to do, and you begin to see them exhibit some good stewardship, then potentially you can increase the amount to them, and it's really not going to matter because they've kind of established themselves. And then what I've observed is once they get above 40, 45, it really doesn't matter how much you leave to them because they've kind of already set their direction, and you can leave them a lot or a little, and it probably really doesn't matter. So the general principle on how much is less rather than more early on, and then depending on how your children are maturing through the decades, you could have the joy of leaving them more that they can then parlay into funding God's work into the future. Now, the second question I think you ask is the form, and this is a critical question, Ed. And this is a mistake a lot of people make. The form of the asset should fit the skills of the recipient. Now, what do I mean by that? In other words, I have 3 boys. One sells coffee, one builds houses, and one works in our business. So if I gave my 3 boys the same exact inheritance, meaning a financial, stock in a financial company, let's say, then 2 of them, that's going to frustrate. They're not going to be able to use that to further what God's called them to do. So the idea of form-fitting skills is the fact that we need to get our assets in a form that fits the skills of our recipients, because we want them to do what God's called them to do. And this is why it's particularly problematic and challenging for business owners, because usually that's the biggest part of your estate. And so most times business owners, 80 or 90% of their net worth is their business, but they may have 4 children. One's interested in the business, 3 aren't. And so how do you begin to deal with that? And I think yet you showed another diagram there a minute ago that showed the estate decision-making process. And I would simply say that there's a concept called capital conversion, that you want to begin to look at your assets, and some of them need to be converted into a form that'll fit some of your children that may be different than the form it's currently in. Form fit skills is the primary punchline on how you leave assets. And then when do you leave them? Here we go. Just scan down through that a little bit. You'll see which form of the assets. So stop right there. So you see the idea of capital conversion, meaning you begin to get the form of the assets in the way that fits the skills of the children. Now, right above there, you see current and deferred giving. So you can leave all your assets to your children in your will when you die, and it's deferred, it's at the end of your life, or you could start giving them some assets currently. And so this is where it gets kind of fun. You need to wrestle with the fact that when your children really need the assets, they probably don't need them, when you're 90 and they're 70. So this is something you need to wrestle with your advisor is, can I bless my children currently as I go along, not just in my estate? And let me just make a comment. A principle about current giving is don't give your children the same amount every year where they build into their cash flow. Surprise them. Different amounts, different years, so they don't get dependent on it is a good principle on current giving. But also there's tremendous joy in seeing your children enjoy it while you're alive. So that's the answer, Ed, to when to give it. I think some currently, just not the same amount every year, and then some through your will would be fine. So mix it up on the current giving.
Mm-hmm. Okay, so continuing on further down on the estate planning diagram here, Russ, just kind of talk through a family conference. What does that look like?
Yeah, so let's talk about that. So just remember that a family conference is not optional for any of us. There will be a family conference. The question is whether it'll be around the coffin or around the coffee table while you're still there. And I would encourage you that once you've done your estate plan, once you've kind of thought through if you want to make current gifts to your kids or whatever, that you bring the family together. And usually after they're above 16, 17 years old, they should be a part of this family meeting. And you start talking about why your estate is what it is, what you're trying to accomplish, what you hope they're seeing, and how that you're managing your assets. And so just remember, a family conference is not optional. You will have one. It's just whether or not you want to be there. And so, Ed, I would encourage the listeners to think about when are they going to communicate about their finances to their children in their estate plan. You don't want them to be surprised. Let me make another comment. It's been said that to the degree there's wealth, if there's not intentional communication about the wealth, it's tantamount to withholding affection. And I know none of you listening would want to withhold affection from your children. So that's going to make it incumbent upon you to be intentional about your communication. So that's what a family meeting is you get everybody together, and obviously your Ron Blue advisor can help you figure out how to craft that, how to put together an agenda, things like that. We've been doing it for almost 40 years now.
Wow, awesome. So, well, Russ, thank you for that. And with the holidays coming up, Christmas and New Year's and so on, a lot of families are getting together. Is there a benefit to waiting to a certain age of your children or a certain stage of life for you, retired versus still working and so on?
Yeah, let me make a comment. Don't try to do these family meetings around holidays, okay? That's one of the things we've learned in our business is that you got to separate family vacations, family holidays from family business meetings. So this should be set aside and done separately. And as I said earlier, usually when your children are above 16 or so, they're old enough to begin to understand some of the things you're talking about. What you actually communicate in a family meeting, though, will be determined between you and your advisor. You may not share exact numbers. You may just start sharing principles early on. That's what we've done in many of our families. When the children are younger, we're sharing principles. And then as they get older, we begin to give them more specifics. So, but don't do it over Christmas. Enjoy Christmas with your family.
Okay, great. So now just below at the bottom of the page here, we have the expectations versus reality and then the coping gap. So I'm sure you've seen a lot of people trying to cope positively and negatively. So talk us through that just a bit, if you would.
Yeah, so basically when you do this intentional communication, you're closing that gap. You don't want your children to be expecting one thing and the reality to be something else, especially as they marry. As in-laws come into the family, they may marry in and have certain expectations about the business or the assets or whatever. And so they're going to start assuming things, having expectations. And so you're bringing in reality, what you're really trying to accomplish in your estate plan, and that will close that coping gap. And so here again, to the degree there's wealth, if there's not intentional communication about the wealth, it's tantamount to withholding affection. So please be intentional in your communication plan.
Yeah, great, Russ. So final word on this slide is on the lower right, we have the techniques. Now, a lot of people fall in love with techniques because their attorney or their CPA and so on told them. Talk us through what the priorities should be when facing the, planning your estate and looking down the line through the generations, your legacy.
Yeah, thanks, Ed. And so most people start with the techniques, but you got to go back up to the top of the diagram and answer the question, how much to kids and how much to charity? Once you've answered that question, then the techniques will become easier. And like I said, if it's less rather than more, then you don't need a lot of complicated techniques. Most people will start with complicated techniques because they think they got to leave everything to their children and they make it all complicated. A key word for estate planning is simplification. So, and I would just say that the techniques will become obvious and clear and usually simpler when you go through this process and ask the right questions first. How much to kids? How much to charity? Do I give it to them currently or later? And then the techniques get easier. So don't start with techniques.
Russ, many people give testamentary bequests, which is gifts through their estates after they're gone to their favorite ministries. So can you talk through the wisdom of giving after you're gone versus giving while you're living?
Yeah, obviously, one way to avoid estate tax is to give it to charity. So a lot of people include charity in their estate documents. And that's not a bad thing to do. But when we have clients that do that, we immediately ask them, well, if you're going to give it away when you die, why don't you move some ahead and give it away while you're alive? Because we have an interesting country here where we have a matching program with current giving. You can give away and deduct up to 50 or 60%. This year, with the CARES Act, you can deduct 100%. Of your income with charitable gifts. And so we would encourage people, if they're going to give it testamentally, that ask the question, why am I not moving that forward and giving more of it currently? Because I might get even better income tax benefits. And if your estate's not above 22 million, you're not getting any estate benefit anyway. So you might just keep that in mind, and we would encourage you to be generous and give currently.
Yeah, we have a lot of clients who have found a lot of joy as well. Because where your treasure is, there your heart is as well. And if you have a ministry that's a favorite cause or somehow touched your heart or your life or your family in some way, doing that, you often find yourself on a board seat, which you may or may not want, but they find great joy in seeing their life's work really, carrying forward while they're still alive. So
the big thing is, it's great to have charity in your estate plan, and I don't want to discourage that, but then you need to say, why don't I give more away now? In fact, just as a personal testimony, I had charity in my estate plan, but since I'm not above the amount that I get any estate benefit, I told my boys when we had a family meeting, I said, hey, you just need to know your mom and I took charity out of our wills, but we're gonna give a lot more away while we're alive. So if you see us giving away your inheritance, that's our plan, but the government's matching it, so it's not quite as bad as you think.
Well, I gotta love that matching gift program. So, well, from a tax standpoint, Russ, there can be different advantages to giving right now, making multi-year gifts during one's lifetime, and giving through your estate. While recognizing that each person's situation is unique, what can be some of the tax and wisdom considerations of these three distinct giving approaches?
Yeah, I just think, as we just said, Ed, that depending on your situation, what we've learned in 40 years of helping people is you can be way more generous than you think. And so just make sure you look down through your net worth, and you might have some appreciated assets that you can avoid the capital gain tax on, and with some current giving. You might have something where you can set up a charitable remainder trust. If you're going to give it away when you die, then a charitable remainder trust is a vehicle that could give you some benefits of a future gift and pull some benefits forward to make it a current benefit to you. So just know that philanthropic techniques like that can usually be very helpful in a good comprehensive plan that's after being a good steward.
Mm-hmm. Great. Yeah, very, very good. And any combination, by the way, works just as well, depending on your circumstances. So
yeah,
good. So our next one, Russ, most people name their spouse as primary beneficiaries and their children as contingent beneficiaries for their IRAs and 401ks or 403bs. What are your thoughts about this commonly used approach?
Well, that's usually the way it is. And I would say your spouse should be the primary beneficiary, but I think you might want to consider as a contingent beneficiary charity or a foundation or whatever, because you still have an income tax liability coming with that retirement fund. So what we like to tell people is you may only be leaving, if you have $1 million in your retirement plan, maybe only 200,000 or only 20% will eventually get to your heirs. And so that's a tremendously important asset on your net worth to look at when you're considering charitable giving. Because here you might be able to give away $1 million, and it's really only a 200,000 impact to your heirs. So Ed, I think that's just one of those first things you should look at if you're considering a testamentary charitable giving, as that contingent beneficiary of your retirement plan being changed to a foundation.
Yeah, that's great, because most people don't recognize that withdrawals from inherited IRAs are taxed as ordinary income and not post-tax like your other liquid assets in your home and so on, the resources from those. So it's a good thing to keep in mind. Beneficiary change costs nothing, and it's pretty quick too. So good. Well, thanks for that, Russ. And excuse me, let's shift more directly now onto today's topic of preparing our heirs to receive an inheritance from us. So what are the key considerations for parents to include in their estate distribution planning? Some of this you've touched on. Let's kind of more pulling it together here. So key considerations.
Well, I think a couple of key considerations is not too much too soon, but understand your children are different. Really realize they're different. And part of your job as a patriarch and matriarch is to figure out how can you use your assets and leave them in such a way to build on these differences of your children. Here again, this is one of the reasons that it's such a challenge for business owners is they may be frustrated because they built this business and it doesn't really fit their children. They may feel like a failure, but no, you're a steward of the capital. And so the idea is, if I need to convert some of that to better help my children continue to do what God's called them to do. So I think understanding differences is a key thing in developing your estate plan. And don't just, that's why there's a statistic, Ed, as you know, only 35% of businesses make it to the second generation, only 13% to the third, because unfortunately, it gets forced to the children in the form of the business. And let's remember that business is only financial capital. I know it may have your name on it, and it seems like it's different than Coke stock or a money market fund or a piece of land, but it's still just financial capital. And just because it has your name on it is still financial capital. So I would just encourage you to understand the differences of your children, form fit skills, not too much too soon. And then talk to your kids about it. Many times we'll interview children, and like I had one guy, and he was leaving his Wyoming house and his lake house to his two daughters, and we interviewed the girls, and they said, well, we're not going to Wyoming if Dad's not here. So you have to kind of find out what fits. And so that's another good practice, Ed, is to interview and have a third party talk to your children. Because here's what we've also learned, that children will say, do whatever you want, and they'll say whatever is okay. Give it all away, or, I'm fine with that, or whatever. But many times they aren't really thinking that. And it's important to have a third party ask them, and you'll get some insights that will help you maybe craft a better estate plan than what you're currently thinking.
Yeah, it's funny when the asset is finally received by you, as you say, it's like, well, we're not going unless Dad's going to be at the lake house and he won't be there anymore. So, the memories are there, and they could be sad memories almost, because they're missing Dad or Mom.
Well, and there's another principle here too. You usually don't want to leave the assets where there's a whole lot of joint ownership. Let's say you have 4 children. Well, let's just take me, for example. I grew up on a farm in Kansas, have 4 siblings, and I can either have 20% of different pieces of Kansas farmland, or I can have 100% of one piece. And it's better for your children to have 100% of something than pieces that they have to deal with their siblings on. And that just makes it more complicated. It makes it harder for them to maybe do what they want to do. So that's another principle, that assets that are left should not be in a whole lot of joint ownership if you can keep from it. Now, that doesn't mean there's not going to be cases where children may have to own a piece of the business or whatever, but as much as you can, don't have a whole lot of joint ownership. That'd be another good principle as you're leaving assets to your children. Yeah,
Russ, it reminds me of one of the clients that I serve, which has a family business. It's a successful business. One of the children works in the company, and 2 of the children have never worked in the company. So they're using some cash to offset to the other 2 that haven't worked in the company. And then the one who has been working with the company for 25 years roughly, that child will end up getting company stock because they know the business really well. They're one of the leaders in the business. And it's not because they're the child of the owner, but because they've worked their way up. They know all the jobs. And so they've decided to split it out. So cash will go one place and stock will go in a different place. And everyone's going to come out roughly the same. Not exactly, but they'll come out roughly the same.
Yeah, let me make a comment about that. Write the word, if you're listening to this, write down the word process. We're talking about estate planning and preparing your heirs and having a plan. And you probably have a stack of documents this thick with an executive summary that's a little thinner that you still don't understand. But it's important for you to graph out your estate plan, but realize that that's a process. Ed made me think of this. I have a client I've been working with for 37 years and had a family business, and he had 4 children. Only one came into the business, but we started 30 years ago. We bought some insurance and a Robo life insurance trust, and we didn't know what was going to happen with the business. And anyway, all these things came together, capital conversion and all that. And we ended up getting the business to the son in the business and equalizing with the other 3 children. But it took 30 years and it was a process. So I would just encourage you to realize that, and unfortunately, the more you have to keep looking at the process. Much has been given, much is required, and part of that requirement is to keep talking about it.
So true, but if you do it once, you're probably not going to like what the outcome was many years later when it's time to pass it on. So, well, you just kind of shifted a little bit into our next question, Russ, which is, do you recommend a specific roadmap for our audience to use when preparing their heirs to receive a financial blessing?
Well, the specific roadmap is, to the best of your ability, you're trying to teach your children spiritual and social capital principles early on, and then you start talking about it. I think if it's the key is communication. I've already said that, and I just think that. And the other thing is, talking about a roadmap here, is make sure you have a will. I would just make that comment. The state already has one for you, and you aren't going to like it. So make sure that part of your roadmap is taking time to actually sit down with your spouse, get a will, and then review it periodically to make sure it is what you wanted to do. I had a family meeting with my family after Thanksgiving here a week ago, and I went back and showed my boys how many times I'd redone my will. First, it was changing guardians, through the 80s and 90s when the kids were younger, and then it was a few other changes in the 2000s. So, yeah, I think that's a good roadmap. Is make sure you have documents, and then start talking about them.
Yeah, that's great. So it's so it sounds so simple, Russ, but so why do we oftentimes not have those documents in place?
Well, I think sometimes we're afraid if we look at it and think about it, we're going to die. I've seen people like they don't want to deal. I got one guy, I think he thinks he's never going to die because he hadn't done his wills in 17 years and he's worth $50 million. So, I mean, I'm like, okay. But I think there's just some reticence. Plus, it seems like it's really a complicated thing. But you got to get started. So force yourself to make sure you have a will. It's probably leaving things equally to your children, and just check the ages. Do they get it at 25, 30, and 35? So I think it's not urgent, Ed, but it's important. And I would just encourage the listeners that if you don't have wills, get them. If you have them, review them and make sure you know what they say, because things may have changed in the last 17 years.
Yeah, that's good. Good wisdom there, Russ. I encourage my clients to review their wills every 5 years and replace them every 10 years, no matter what. Even if they say nothing's changed, like that's the latest one, that's the current one. As you know, it always says it supersedes all previous wills. But it's such a good idea to sit down every 5 years, because 5 years, when you get into your 50s, 60s, and 70s, 5 years is a really long time with a lot of very significant life changes, maybe marriage of your kids, grandkids, sale of a business or retirement, or even starting a new business in as a second or third career. So many things can happen during that time. And, you get busy and life gets fun and you're traveling maybe more and so on, if you're healthy enough to do that. And you just sort of forget it. And that's, I think, the benefit that we bring as advisors to our clients is say, let's go back and look at those wills, how they're looking. I've heard a lot of times, oh, it's fine. Then you open it up and it's not fine. So just a good idea, good practice every 5 years to review and every 10 years to replace. So
and I had a guy one time, he said to me, yeah, I think I had a will, but it may even be lost. We were talking about the importance of knowing what he had and what was going to go to his children. And he said, yeah, I think I have them, but they may be lost.
Yeah, I've come across wills that were never actually executed, not signed and not notarized. So the will was done, but it was invalid because it wasn't signed and notarized. So, and it's a simple thing to overlook. The attorney sends you a packet and you go, okay, that's all done. You don't realize you have to sign and have it notarized to be active. So those of you on the call or webinar here who are listening, go check and make sure you sign and notarize your wills. So Russ, congratulations on 40 very successful years of leading our firm. You've been amazing. Employee number 2 and CEO for a long time, and now executive vice chairman and chief mission officer and so on, executive VP as well. But those 4 decades, Russ, they represent 2 full generations of clients. About every 20 years is a generation. So you're an expert in both the technical aspects of estate planning and also the biblical stewardship perspective. So you've helped many of our clients create their estate plans, prepare their heirs, and you've seen the results after many of our clients have passed away. So can you share some success stories with our audience of how our clients successfully prepared their heirs and how their heirs handled their inheritances well?
Yeah, thanks for asking, Ed. I'll share a story to try to paint this picture for you all. Had a client started working with in the 80s. We did what we just shared with you all. We started having family meetings. They had 4 children. Their estate was growing. Things kept changing. And you went through the 90s, had a couple more family meetings, got into the 2000s. These folks passed away in the last 3 years. And I tell you, Ed, I went to the funeral. And first of all, the church was standing room only with people there because of this guy's generosity. But here was the most impactful thing at the gravesite. One of the Gen 3s, one of the grandchildren, came up and thanked us for working with their granddad. So I think the idea there is that here was a patriarch that was willing to engage in the process of looking at his estate plan, like you said, every 5 years, updating it, making changes. And now generation 3 is thankful because they weren't left in the dark. They weren't surprised. These people were able to be very generous with not only their family, but with God's work. And that's what I've seen. I've seen that it's not easy to do. You have to sit down and have meetings and all that. But that was a beautiful picture of what I would hope those listening can envision for themselves is that will your grandchildren and your children be grateful that you've done these things for them at your death.
Yeah, that's great. That's great. So are there any specific key drivers? You touched on, obviously, communication being a key thing, but any other key drivers of the success of successful outcomes?
Well, have a will. We said that. That's the first successful driver. And then just really looking at your assets and beginning to get them in a form that will help your children be able to carry it on into the next generation. That means you won't have a lot of joint ownership of things. And so I just think it's important. The key driver is looking at your assets and then looking at your children and their differences and saying, okay, how's this all going to work out? Here's what I would say, Ed. The longer term your perspective, the better your decisions today. And many times, if you don't force yourself to take the assets through the estate, you'll have unintended consequences that you didn't plan on. The guy who says to me, I can't believe I'm the trustee for my sister, that was never the idea. And so you just got to make sure that it's one thing to have the estate plan and the wills, but then make sure your assets fit that estate plan and you don't have any unintended consequences.
Yeah, that's that I've seen a few myself. They're never fine. Well, that kind of transitions to our next question, which is on the opposite side. What were some of the reasons many estate plans have failed or at least under-delivered for future generations?
Well, I've seen situations where the parents didn't really know their kids, and so they're leaving the business to charity, and their kids really want the business, so everything blows up, right? Mm-hmm. So I think here again, they didn't know their children, and here's what happened was by having a family meeting, we uncovered that. Better to uncover while they were alive than if that would have just been in their will. So I think one of the things that can blow up is or another thing that can happen, Ed, is I've seen people give all their assets to charity, and their children have to give the money away, but they don't get any money. Okay, well, that's kind of a bad outcome too. So I've seen that happen. I've seen frustrated Gen 2s and Gen 3s saying, yeah, mom and dad gave all this money to the foundation. Now I've got the responsibility of giving it away, but I don't have any money. And so you can, I would put this all under the unintended consequence banner. And it could be having complicated ownership structures. It could be having trustees of siblings and others, or multiple trustees. Maybe you have to work with two siblings and you got three trustees of something, and that creates a problem. So unintended consequences, they can take all forms, but you ought to kind of know what it looks like through your estate.
Great. Yeah, no, it's very unfortunate. So I'll just share personally, my wife and I have 4 children, all young adults, and our will has 5 children. The 5th one is our donor advised fund. And some of that we'll give away immediately through our donor advised fund. The instructions are there. And some will go to each of the kids. So they'll have donor advised fund accounts. There's some funding from mom and dad with the encouragement that they would match whatever they give by using the funds from that. So there's all kinds of tools and ideas out there, some very, very creative and so on, but it doesn't leave them without anything. So Russ, kind of summarize, if you would, here before we shift again, just the best practices, just so everybody has if they've been taking notes, they'll have best practices.
Well, best practices would be, make sure you have a will, make sure you know what they say. And by that, I mean, not just words, but take your assets and flow them through so you can actually see what assets go where and who gets what. I didn't know that the 3 kids were going to have to share that lake home, and I don't really want that. So do the wills, flow them through and see where there might be some unintended consequences, and then figure out when you're going to start talking about it. Because like I said, it's not optional. It will be talked about. And hopefully you're there to give some color commentary, explain your heart, explain the values that you're trying to pass on. My wife and I've been talking about this for a long time now. And I was at a meeting in Alabama a couple of months ago, and I thought, I need to do intentional communication. So Julie and I just had a family meeting the Saturday after Thanksgiving, where we set my 3 boys and their spouses down. They're in their 30s, and kind of share with them just what I've been talking to you all about. Here's our estate. Here's how it flows through. Here's what happens. Here's what we're trying to accomplish. We also gave them each a $100 bill and said, you need to give it away by Christmas, and then send us an email or call us and tell you who you blessed and how you met a need with that $100 bill, because we're trying to pass on the value of generosity. And so that was also, and I just got my first email today. They went out to eat, my son and his wife, and they were able to bless the waitress last night. So 1 down, 5 to go. We'll hear from 5 of them, 5 more to go. That's great.
Well, speaking of Julie, maybe you can give us, for the audience's benefit, an inside look at how you and Julie have prepared your 3 sons. And we kind of talk about one of the things right there. But along the way, I mean, your sons are all in their 30s and they're all married. So what have you done with them beyond doing the $100 recently?
Well, Ed, I've been doing this for 40 years. I've been blessed to see people do it right and do it wrong. And so obviously early on, we realized that we had to help our children understand money and the trade-offs, giving, spending, saving. We started trying to train them. But here's the key thing that I learned, Ed. When I asked my boys, what's the most important thing? They said, you modeled it. So I would say to you, if you're listening, they're watching, your kids are watching. And so the best thing you can do is you be generous, you be intentional, you talk about it. And that's the best thing you can do. I thought the boys might have said, hey, Dad, that meeting you had, or that, when you did this, or when you had that devotion, or blah, blah, blah. But no, they said, we were watching you and Mom. So model it. I had to sum it all up. Your kids are watching. They don't miss anything. And so as they see you engage in this thorny issue of how much to kids and when and later or now, if they see you wrestling with that, that's going to say more to them than you realize. So 2 words, model it.
Okay, that's great. So thanks for all those wise insights, Russ. So we're going to pivot now to some Q&A. We had a couple of questions came in ahead and several more that came in the chat window now. So let me, I'm going to run through a couple of them. I'm trying to stick to that. To briefer the better is because it's a webinar with a lot of people on it. So first one, in a divorce situation with kids and grandkids plus significant wealth, how should one ex-spouse handle their estate planning when they expect the other ex-spouse to continue to grow their substantial other half of the split assets and eventually give it all to their kids? One ex-spouse doesn't think the kids need more money, and they are already concerned about their adult kids' spiritual health.
Well, this will sound like a cop-out on the answer, but you obviously have to talk about it. I think you got to be careful to be perceived as somebody who didn't give anything to the children. Like in this case, you're saying one ex-spouse doesn't think the kids should have any money and they're going to give it all away. I think that's just where, you probably need some outside counsel too, to help you wrestle with, because in your mind, it may be too much. Somebody may say, well, it's really not too much. And this is why, Ed, this is a process and these are thorny issues. But the principle here is you probably don't want to ever not leave your kids anything. That'd be the last thing you've said to them, and they may measure love by that. But how much you leave them, and if your ex-spouse is leaving them what you think's too much, or leaving them more for you than to say, I'm not leaving them anything. I'm not sure I would do that. Probably leave them something, but talk about it. Talk about it. And I know I'm sounding like a stuck record, but the principles are the same for everybody, but how they get worked out will be different based on your specific situation.
Yeah, that's great, Russ. Another option for them to consider, to this person who wrote in, is to consider helping their children now, maybe with the purchase of a first house or a second house, or helping to fund the grandkids' college education and things like that. And it may be that nothing goes to them later, but right now, if you're waiting for dad, I assume the mom is one who wrote in, if you're waiting for dad to die, that could be 30, 40 years. But right now, the kids need some help. So you touched on that before. So you could be creative. It doesn't have to be only through your estate, right?
So, Ed, I'm looking at a chat question here that I'd like to answer. Can I do that?
Yeah, go for it.
At what age is social capital, work ethic ingrained, and when should we start sharing specific numbers and know that there is not a danger to the development of social capital? So obviously you start building social capital early on because you're trying to teach your kids to work and realize there's trade-offs. So that starts, at an early age, doing chores in the house, doing lawn business, babysitting, whatever it might be. I think when you share specific numbers will become clear. Sometimes that's not till they're in their 20s. I remember a client of mine, we were trying to decide when to have the family meeting and share numbers. And then I asked the boys what they thought their dad made. And one of them said, well, I think dad makes 200,000. But then he said, no, my brother told me he makes 2 million. So I told my client, hey, they're starting to figure it out. We probably need to manage expectation and reality and give them the truth. So I think, I think probably in their 20s at some point, because they're going to start trying to piece stuff together. You live in a nice house, you've got this business, they know it's successful. So at some point, you're going to have to get the facts to them. But that's not when they're 14 or 17. It's usually probably in their 20s, but you start the social capital development early on.
Okay, yep. So good wisdom there. You want to take the next question down, Russ?
What's a charitable remainder trust and how does it work? Yeah, thanks for asking. A charitable remainder trust is simply a vehicle where you put an appreciated asset into it and you sell the asset and don't pay any capital gain tax. So that's one of the benefits is if you're getting ready to sell a stock, you put it in there and sell it, you don't pay capital gain tax. But then you can get an income. You set an income, interest rate income from that trust that you get the income from for your lifetime, or maybe you and your spouse's lifetime. And then at the end of that period, the remainder goes to charity. So many of our clients, we've set up charitable remainder trust, but then as they go on through their life, they realize they really don't need those assets, and we go ahead and give it to charity even before they die. So this is simply something you might want to consider if you've got charity in your wills. It's just pulling forward some of that that's going to be given later, setting up this entity now, and getting some current income tax benefits and some extra income while you're alive. So
that's great. Okay, excellent. So next one says, do you think it's prudent to file the will with the county you live or leave for the children to divide out? Now, part 2 of that says, I ask because I have a blended family, stepkids and my own kids.
Well, I don't know. I can't answer the file the will with the county you live in. I wouldn't know that. That's too technical for me. I think if just back to this issue of living aggressively destructive lifestyles and others walking with the Lord, that's a common question we get. Okay. And I'm just going to give you my personal opinion. You can't find in scripture where it tells you. I know people will say, well, I've got to be a good steward. I can't give it to the destructive one. Well, go to the prodigal son. Okay. I've concluded that if I'm going to err, I may have a wayward child. So I'm going to read the will. He's going to hear from mom and dad, hey, you were disowned. You were cut out. That's the last thing he hears from me. I'm not sure I want him to hear that. And you have to wrestle with this. I know there's different schools of thought on it, but I go to the prodigal son, and I would say, how that may be the last message you say to that destructive child. And Christ loved us when we weren't lovely. So I know it's a tough one. We want to see our kids all tracking. We can hide behind the stewardship card. Hey, it's a bad stewardship to give it to the one that's wayward. And I know these are sticky, and there's, like I said, that's why each one you've got to look at differently. But I've just concluded, and I've watched people, the gentleman I used the story of, the standing room only at the church, he modeled for me erring on the side of generosity. So if it comes to push to shove, I'm going to err on being generous. And that means I'm probably not going to cut somebody out. And so anyway, it's something, like I said, it's a process. Every situation is different. We just got to be very careful. And sometimes you don't over spiritualize it, is what I would say, under the stewardship umbrella.
Yeah, good stuff. So I got one that's not here in the chat. It came in earlier. So okay. What book or other resources do you recommend for trust information? Also, what government agency or board regulates the trustees, or to whom the trustees accountable to follow fiduciary guidelines? Yeah, so you can be glad to know one of the reasons Ronald Blue & Company became Ronald Blue Trust was it's the highest fiduciary position you can be in. It's governed by the OCC, the Office of Currency and Controller. So that you just need to, that's the governing agency, the highest level of fiduciary responsibility. And so that should give you some comfort on that. Other information and resources on trust information. We have a group in our company that's a deep trust expert group, estate and trust. So you could reach out to them to get more details, because there are some nuances about trust. In fact, that's one of the reasons we have an estate and trust group, is to know all the nuances of trust and all that. Yeah, great. So how about a book, Russ, on trust information? Is there anything in particular? Certainly your book, Your Life Well Spent, helps somewhat, but it really prepares the background for it. But is there a book in particular you know of that would be good to read up on? I really don't know. Here again, reach out to your Ron Blue advisor, reach out to Ed. He can check with our estate and trust people. Maybe there's a book they would recommend. I don't know one. I would recommend Your Life Well Spent, which talks about how to invest your money to build into your posterity and build spiritual and social capital. We got 2 chapters in there on how to invest in building spiritual and social capital, called an alternative investment. And just so you'll know, I used to never think that way. Everything would go into a financial instrument, but now I consider some of the use of money as an investment in spiritual and social capital as an alternative investment. The definition of an alternative investment is as different return expectations and different time frame. That's exactly what's happening with our children. We expect, we're expecting a different outcome when we invest in our children and grandchildren. Great. And if anybody on the call would like a free copy of Your Life Well Spent, just contact your local Ron Blue advisor and we'll mail you a copy or hand that to you. But it's a great book, really prepares the background of all of what Russ is talking about, the philosophical side here.
So Ed, I see another question about this destructive child receiving an equal amount and have Ron Blue trustee allocate the inheritance. Yeah, you can always set up a trust. And that's one of the reasons we became a trust company, is because clients want to pass on their values and have a like-minded trustee that has the same values. And so, yeah, that'd be a way. And that way we could keep speaking into the individual's life. And as we made distributions for whatever reason, hopefully we'd have a chance to continue to have input. So yeah, that's one of the reasons we became a trust company, was because our clients were saying, hey, can you be trustee? And when we were an RA, we couldn't, but now we can. And we can hopefully continue to pass on your values to maybe this wayward child. So the answer to that question is yes. Thanks for asking that, whoever asked that.
Okay. We have an insider wrote, Hunter Pugh, tell about the treehouse investment.
Oh my goodness. Okay, so we had our first cousin camp. You're back, Ed, to how we're investing in our family. So we decided to do a cousin camp this summer. My wife and I, we have 5 grandchildren living, and so I was going to build a platform for a zip line, and it morphed into a $5,000 treehouse. And so anyway, but I looked at that as an investment in posterity, not an expense. In my prior life, that would have been an expense. But yeah, so yeah, I have a treehouse that I'm going to go sleep in some night, because that's how nice it is.
Well, let's hope you don't have to live in it someday.
Yeah.
So I want to go back to the couple that wrote in earlier about filing in the county or not. That's a great question for your attorney, your estate attorney, because there could be, the local laws vary and state by state they vary. So it'd be a really good idea to just bring that back to your attorney and ask them. You just want to make sure that all what you have written into your estate documents are going to actually happen. So, but you certainly don't want a blended family to argue it out. They may be coming from different places, so you don't want to leave that open. So, and Russ, how about using a revocable trust along with the will?
Yeah, I mean, it depends on what state you're in. Usually in community property states, you will have a revocable trust to go with your will. And here again, it's going to depend on, I mean, there's reasons you might want to have it, but they don't fit all the time. Sometimes you just have wills, and the trusts are created in the will. So you may or may not want to set up a revocable trust simultaneous with the wills. Usually I've seen in community property states they do, but here again, ask your Ron Blue advisor or reach out to our estate and trust group and ask them. But you don't always need to have a revocable trust with your will. Sometimes you will, sometimes you won't. It kind of depends on your assets. Assets will be a driver on that to a degree, and things like that.
Mm-hmm. So, well, another question that came in ahead of the call today, with world missions in mind, what is Ron Blue Trust's philosophy and vision of how best families can prepare to facilitate, meaning serve and bless, the kingdom of God by incorporating charitable giving into their overall family legacy strategy?
Well, that's a good question. So let me everybody likes the word legacy. So remember, if you're listening to this call, you're building your legacy right now. And when you die, that becomes the heritage that you've left to your children. And we all have a heritage. We all have something we brought from our families. It could be good or bad. And so part of this legacy that you want to leave is a legacy of generosity, I believe. And so here again, model it, include your children in it. Many times clients will set up donor advice funds for their children and encourage them to give it away. And then at a family meeting, explain where they gave it. This $100 thing I just did with my sons and their wives. I mean, so part of it is you passing on the value of generosity by modeling it, and then including your children in that, I think is very, very important, because if you leave them these assets, you want them to continue to be generous after you're gone. And so I think, it's a lot of fun. And that's one of the things, I didn't grow up in a family where generosity was modeled at all. And, just a couple of dollars on the plate, maybe on Sunday and all that. So I've really been intentional about trying to model that for my children, and I've seen them start to pick up on that, which has been very rewarding. Back to your first question, Ed, what are some of the rewards? Well, when you see your kids actually picking up some of the stuff you've done. So be patient. I was talking to somebody the other day, they have a 15-year-old. I said, those are the stupid years, so just relax, he'll grow out of it. But give them some time. And they're catching everything, even though they're not listening. Remember that.
Yeah. Well, Russ, take a look at the last question that just came in. We're nearing the end here, but I want to respond to that question. What if you have an adult child and have not started sharing with them spiritual capital?
Well, I think, you start where you are. you say, hey, here's what I'm learning. One of the things I did with my boys in our first family meeting 3.5 years ago is I shared with them our spiritual journey. I shared with them what God had done over 40 years. And by the way, I forgot to say this. You need to help your children understand what God's done to bless you. You didn't just get where you are overnight. We had a family meeting one time, and one of the grandkids said to the granddad, thanks for sharing that. We didn't know you ever worked. Because there was all this pile of wealth, right? And so part of this is just helping them understand, here's what God's done. Here's how God's blessed us. Hey, son or daughter, we realize we got to be a good steward. So we want to be more intentional about how we give and live and what we're involved in. And so I think you just start where you are and help them. Share that life overview diagram and share that, you've been blessed with financial capital. You want to be able to bless them like you've been blessed, but you also want them to balance the spiritual and social capital. I'm looking down here at this next question. Let's see if we can answer.
This will be our last question, Russ. So I found a question here. The one you just gave.
How do you recommend believers balance being open with their children first and then others through generosity groups while not letting your left hand know what your right hand is doing? Obviously, that's one of the nice things about working with a group. We worked with the National Christian Foundation. I was the executive director of that for 3 years, but you can do anonymous giving. So sometimes it's helpful to use a vehicle like that so that you can be anonymous. And so I don't know if that's the answer to what they're really asking there. But I do think there is a place for some anonymous giving as part of your overall generosity strategy.
Yep, there's a lot of options there, but I think the tone of this one is, how do you not be prideful in sharing how successful you've been, but you're generous, you want your kids to be generous without saying, hey, look how successful we've been, because that is always a big balance and trade-off for people. Well,
so thanks for bringing that out, Ed. Here's what I would say to that. All this discussion and intentional communication should point your children back to God. Mm-hmm. Psalm 78, 5-7. That he commanded our fathers to teach their children, that they would teach their children to teach their children, to put their hope in God, not forget his works and keep his commands. And so when I shared with the boys what God had done, my hope was that they would see what God had done and kept pointing back to God. It wasn't anything I did. It's not anything you've done. It's a blessing of the Lord which makes rich, Proverbs 10:22. So part of it is, you can be generous because God's been generous to you, and you're not trying to be prideful about that.
Well, that's a great note to end on. So, because we do need to wrap up soon. So I want to thank everyone for joining us on the webinar today. If you have any questions or want to talk through your thoughts or plans, ideas, or concerns with someone, please contact your local Ron Blue Trust advisor. And if you do not yet have a Ron Blue advisor, please visit our website, www.ronblue.com. Click on About, and then you'll see a list of our advisors. There's a selection for advisors, and you can go through and search by location or a name and so on there. But also, if you'd like a free copy of the book we referenced, Russ's book called Your Life Well Spent, that is available by contacting any Ron Blue office and just say, I was on a webinar, and I want a free copy of Russ's Your Life Well Spent book. You will be blessed for having read it. So also, I want to let you know that this webinar was recorded, and it will be published soon up on the Ron Blue Vimeo site and our YouTube channel as well. And also our advisors will be receiving it as an email, which will be a link to the Vimeo and YouTube. So if you have someone that you was not able to be here, maybe a spouse or a family member or a friend, please, this will be available soon, and you'll be able to send the link out and invite them to watch it, hopefully even with you. But obviously, Russ, you could see the depth of his knowledge and wisdom on this topic, and so he's seen a lot and done a lot in his 40 years just at our firm. So Russ, thank you so much for sharing that wisdom with us today. It's just a real privilege to have you on the call and breathing hope and life and clarity into our clients and our friends and others that were able to join us today. So thank you, Russ, and thank you everyone for being with us today. God bless y'all.